Would you like the IT space then, Nitin? Because the client spends there have improved healthily in the last couple of months for sure. Any favorites in that space?
I think a lot, is already in the price. We are not running any significant value or discounts to what's potentially ahead. Clearly, there may be some positive surprises at which point people will take a look at it. But I think the larger IT names are trading pretty much near their highs. Obviously, it's a good sector to have, but I wouldn't say overweight. Definitely a neutral stance given the valuation status right now.
You saw the auto numbers yesterday and they look pretty impressive, Nitin. Would you continue to be overweight and back this space, or do you think they're trading at cyclical peaks of demand and things might start slowing for them?
No, I think I would actually say that we need to be overweight on autos on two counts. First and foremost, I think we don't know whether this is a cyclical peak yet. I think we're heading into the festive season. We probably are going to see a fairly significant growth environment, at least over the next few months. Monsoon is clearly a big positive for the auto sector, given the fact that it has a very large segment of population on the rural India side that actually is a direct buyer, especially two-wheelers, and also commercial vehicles to some extent. And also, I think, given the fact that most auto companies are trading much cheaper to the compared to even the broader market, gives us a sense that I think there is still some steam left. I think we'll continue to probably get positively surprised by the momentum that we see in the sector. And I've been one of those fairly strong proponents of being strongly overweight on the sector, and I think we continue to feel that way.
Nitin, what about the entire banking space? Because that one's been very active of late. What would the call be between private and PSU now?
I think over the last couple of weeks at least, the banks had cooled off a little, so I think one can expect them to start picking up again. Clearly, this is one sector that will, I think, continue to outperform the broader market. Over the last 5 years, it's actually given 50% more returns than the broader market, and I think we think that's going to continue given the fact that we are in a fairly strong, credit demand as well as a savings environment. Given the fact that the private sector banks are almost always at almost a 50% premium to their PSU peers, one can clearly expect better value in the PSU banks. But again, I wouldn't be surprised if we continue to see 15-20% growth across the board in the sector, and hence you can expect that kind of return from the stock prices on an annual basis.
Because of valuations, Nitin, some people are shifting out of the auto space and into the auto ancillary basket. How does that space look for you?
Again, honestly, I think they're both fairly correlated. Clearly, the ancillary space is seeing a lot more action because they've been in the news, given that they've been the constraining factor for the auto companies to grow. So I think clearly both of them are actually in a pretty good place. I don't think the auto valuations are stretched. I think there's a higher margin of safety in the frontline auto companies than in the ancillary companies. So I think it's really a very, very correlated space, and it's prudent to have a mix of both, but not just move from one to the other.
What about the broader market, Nitin? That's the clear play field of most people out now, because the Nifty as a trade has not generated great returns. Do you see this kind of underlying strong broad market performance continuing, the mid caps and small caps?
Mid caps definitely, I think, have held up fairly well, even though they seem to correct a lot more, given that they are mostly higher beta names. I think the interest in the basket of mid caps will carry on. Small caps, I think one needs to be really, really selective. Even though it's a cyclical model, the large caps do what they do, and then the action moves to the smaller companies. I think given where we sit today, we still think that the maximum opportunity for growth really comes from the top 200 odd names, given the fact that there's a fairly strong economic recovery that actually is benefiting them as well, and given the fact that there's a fairly high margin of safety. So I think definitely a case for having a combination of large, mid, and small, but probably in that proportion is what we will recommend.
Some of these realty names too are looking good. So India Bulls, DLF, HDIL, all of them have put on about 1 to 1.5% in trade at this point. Nitin, how does this space look to you? Does this look like a good level to enter into some of these stocks, considering that they have been seeing a slump in the last 1 or 2 weeks?
I think for the last couple of months, reality has been looking like the dark horse, and I've maintained that view. We may just get surprised by the stronger recovery. Given that it's a high beta name, it tends to get beaten down always a lot more. So I think one needs to have a very, very strong and good portfolio that you probably can have in your holdings. Again, not from a trading point of view, because these tend to be higher beta, but whenever you get a chance, I think building a portfolio around a good reality names is prudent right now.